How's it going, everyone? Welcome to the next episode in the private mentorship for the Pipcatcher expeditions. Today we're going to be learning about fully grasping time and price theory. And remember, without time, price is useless. Without price, time is useless. So today we're going to be going over into depth of time and price theory. Now, in the past videos for the mentorship program, we had gone over time and price theory. But we did not go into depth of it and how we can use it to our advantage. This is understanding the price algorithm of the market. This is understanding how market makers use the algorithm to their advantage. And if we can understand this, we could take advantage of it by using it for our own benefit. Now, what is so important about understanding time and price? Without time being in the equation, every price segment is irrelevant. So, in language terms, without time, price is irrelevant. Price doesn't matter without time. Same without price in the markets, time would be pointless of being in the equation. So, without time, price is irrelevant. Without price, time is irrelevant. So, they go hand in hand. So, without one, the other can't exist. So, remember, without time, price doesn't matter. Without price, time doesn't matter. They both go hand in hand with each other. They need each other to be an example of what could possibly happen within the market, because without one, the other is irrelevant. Understanding this is important because this is how high frequency algorithms operate. So if you are not in tune with time and price, you are basically trading like an average retail trader and are trading with low probability as a gambler, or you are trading just like 90% of the traders who fail. Okay? So, take a moment. Look at that. See what you think it means in language terms. Got it? Okay, so what this basically means is if you do not understand time and price and how they work alongside of each other, you are trading in low probability conditions every single day. The reason is that because you don't understand what the market algorithm does and what the actions of it does, you are basically trading based off of patterns, or as retail traders trade. They trade in patterns. We don't trade patterns. We trade with the algorithm. We understand what the algorithm wants to do and what it plans on doing. So if you don't understand time and price theory, you won't in return understand what the market would anticipatingly be possibly doing. Okay? And remember, guys, 90% of traders who start day trading, they will fail and they do not make money and they will give up on this. So, if you do not understand time and price theory, you are going to be trading just like the 90% of traders. So please take notes on this and understand it. Go into depth of actually trying to find in your mind, what does this mean? What does that mean? Because if you don't ask yourself these questions, you're just watching the video and you're not paying attention. It's just like school. Let's be honest, nobody gives a fuck about fucking school, okay? But here, if you give a fuck about making money and making a living with this, you need to be able to grasp it. And by grasping it, you need to pay attention. By paying attention, you need to ask yourself in your mind these actual questions about what does this mean, what does that mean? Because if you don't understand the market, you won't be able to make those long-term goals in terms of making a living for yourself with this. So think short-term of understanding price action. After that, then we can talk about in your own career of trading how it would go for you. Okay? So, the power of three, or accumulation, manipulation, distribution, also known as AMD. Okay? So we had gone over this in the previous time and price theory video in the mentorship, but here we're going to go over it one more time and we're going to go a little bit more into depth of it, okay? So, the power of three, also known as accumulation, manipulation, distribution, is the basis of what occurs every single day within the algorithm. So, the algorithm cycles with AMD, as in for price to get to the market sentiment area, or target it needs to accumulate liquidity. Okay, so the algorithm wants to get to the market sentiment. Market sentiment basically means what the market sees. So sentiment is perspective. Okay, fuck, I'm stuttering. But okay, so market sentiment is perspective. With perspective, there's two types of perspective. There is market sentiment and there is people sentiment. Market sentiment is based off of values and data and statistics. People sentiment is based off of perception, what people perceive. So like supply and demand, that's what people perceive. Market algorithms don't know what people's sentiment is. They only know what market sentiment is. So the people that trade supply and demand, that doesn't work. They're basically trading off of patterns. They trade off of patterns. They're retail traders. We don't trade off of patterns. We trade with the algorithm. The algorithm as in market sentiment. We want to know what the algorithm wants to do to target these market sentiment areas. And for it to target it, we need to understand time and price theory. So remember, accumulation, manipulation, distribution. This is so that it can get to that market sentiment or target for it needs to accumulate liquidity. Okay, so accumulation, accumulating liquidity. Manipulation, market makers are manipulating traders into getting stopped out to add more liquidity into the market. Distribution leg, this is distributing all of that liquidity for market makers to take advantage of that for their own benefit. And understanding all of this can benefit us in catching a trade without getting stopped out. Also, when you involve market makers, or they're known as smart money, also known as institutions, they are the people controlling most of the liquidity coming into the market on price, so manipulation will be occurring, which will, in confidence, stop out majority of retail traders, which increases liquidity in the market as well. Alright, so whenever you have market makers inside the equation, you're gonna have manipulation. So understanding when this manipulation occurs is important to not getting stomped out, number one, and number two, getting a head start or a jump start of when the distribution leg could possibly happen. And finally, with all the liquidity and traders stopped out in the market, it will inevitably distribute all the liquidity to reach the original market sentiment, other known as the market target. So you have accumulation, accumulating liquidity, or accumulating stop orders. You have manipulation, which is manipulating all people to get stopped out on both sides, the buy side and the sell side of the market, adding more liquidity to the market. And finally, we'll have the distribution leg, which is distributing all of that liquidity into the market for the benefit of the market makers. So they'll put on their trades in that sense. All right. Now, let's go over the Judas swing one more time. So we did go over the Judas swing. We're going to go into depth of it one more time. Alright? The Judas swing is the manipulation move of the power of 3. This will occur every single day, but the hard part is understanding when will it happen. Manipulation will always occur on multiple factoring times, and this includes manual intervention times, session opens, and or news events. We can spot these of occurring at a specific price point by pointing out pools of liquidity, unmitigated PD raise, and or engineered liquidity. These will usually happen intraday and or per session time. Alright? So if you take a look at these models here, and we're paying attention to intraday. So Asia, London, New York AM, New York PM. We have Asian session, we have London session. What happens at London session? We take out the Asian highs, which is what? Buy side liquidity. And when we take out those Asian highs during London session, that will be known as our manipulation move to the upside, taking out buy side. So we are accumulating liquidity here in Asian session, and we manipulate to the buy side, taking out liquidity during London session. And then once New York session starts to happen, that's when the distribution of all that liquidity starts to play out in time. Same thing with here with Asian session, and let's zoom up close here. We took out equal highs, which is engineered liquidity, with a liquidity sweep. This is our manipulation move to the upside, sweeping buy side here. In return, we are trading back down lower to take out the Asian side or the Asian low side of sell side liquidity. And in that, we're taking out sell side. So we manipulate higher to trade down lower. Alright, so that is the basis of the Judas swing. And these will happen on manual intervention times, session opens, so like 3 a.m. Eastern Standard Time for London session open, and also 9:30 a.m. for equity open during New York AM session. And also doing news events or manual intervention times, which would be high impact news such as FOMC, NFP, CPI, PPI, and unemployment. So this is called IPDA. So IPDA is something that you will learn when you watch the ICT core content, and this is the basis of price algorithm. So IPDA stands for interbank price algorithm. So interbank price algorithm. And this is an algorithm that institutions use to target liquidity, market sentiment, and values. Smart money uses this algorithm with the high frequency algorithms to reach their identified price targets. Markets will cycle through this algorithm every single day, every single week, and every single month, and it will continue doing this until the markets are completely gone. So until the markets are they're dead. Like, there's no money in the world, there's no market in the world, there's no currency value, like there's nothing. These concepts will continue to work forever. They will not stop. They will not be, dead. They'll never stop working until the market shut off. Like ICT said himself, until the market shut off, these concepts will forever be working. This is how the market algorithms work, and they won't stop. This is how the algorithm works. And you guys need to understand this and believe this. You need to subscribe to this. If you don't subscribe to this, you guys will be trading blind. All right? So, the IPDA or interbank price algorithm goes in a cycle, and the cycle goes like this. It goes from consolidation to expansion to retracement or reversal, one of the two, back to expansion, and then repeat. Alright? And it's going to repeat in that order. So you're going to go consolidation, expansion, retracement, reversal, expansion. Consolidation, expansion, retracement, reversal, expansion. And you just repeat and repeat and repeat and repeat and repeat and repeat and repeat. And it's going to continue doing this, and it will not stop. It does this every single day non-stop until the market closes. And then once it opens again, same fucking process. It's going to keep on doing it, and it's going to keep on doing it throughout the whole week, and it's not going to stop. This is the algorithm, and it's not going to change. This is interbank price algorithm, and the interbank price algorithm does not change. They will not change it ever, and this is how the market algorithms work, okay? You guys need to remember this. Now, when the consolidation happens, and we're looking at this from an intraday perspective, okay? So on a daily perspective, right? When the consolidation happens, this will usually be occurring within the Asian range. Accumulation, right? Accumulating liquidity in the Asian range. Okay? Next, we'll have the expansion move, which is going to be the distribution leg right after the manipulation leg, which is going to be the Judas swing. After that, we're going to be having our retracement or a reversal during the New York session. And this will be during the New York session, during New York, or we'll have our London swing, which is going to be our distribution move after manipulation move during London session. And then after that, we'll have our continuation with the expansion move again. And then we'll repeat and repeat and repeat. Okay, so you remember IPDA, interbank price algorithm, and it goes from consolidation to expansion, retracement, reversal, expansion, and repeat. Alright? So, let's go over consolidation. So consolidation, also known as in the power of three that we had went over, this is known as the accumulation phase. And this is where markets will gather liquidity to be collected in the markets for future reference. Market makers will take advantage of this by using the gathered liquidity, also known as orders, on both the buy side and sell side by the algorithm for their own benefit of using it to take on trades in their intended direction. Market makers will usually take advantage of this by implementing manipulation for their own benefit while leaving retail traders in the dust. Accumulation will occur by moving inside of a trading range without the willingness to move higher or lower. We can expect expansion soon to come after spotting this portion or phase of the IPDA or interbank price delivery algorithm. We can expect a price swing away from equilibrium, which will be midpoint of the consolidation range. Alright, make sure you write all of that down, and then let's dissect this one by one, okay? So, consolidation, also known as accumulation. We're accumulating liquidity here. We're accumulating stop orders here, right? Creating our consolidation high or consolidation low. But since this usually occurs during Asian session, we create our Asian high and Asian low. We are not showing any willingness to trade higher or lower. We are banging off, as what retail traders see as support and resistance. So resistance here at the highs, support here at the lows. But what we see as knowing how market makers spot things, we see this as engineered liquidity, also known as equal highs and equal lows here. When we spot these, we can see in our mind or in the future that, hey, the market's going to take it out sooner or later. It's not going to continue bouncing off of this to catch lows or bouncing off of these to catch highs, right? All right, so when we spot this, all right, we want to be able to take advantage of this and then anticipate the manipulation move to be coming, all right? So the manipulation move coming and then the expansion move, expecting it to come later on, all right? So what we can anticipate of which side it's going to take out is we want to pay attention to equilibrium, right? So let's pay attention to this model up here. We have our consolidation high and our consolidation low. Midpoint of this range is going to be our equilibrium. So equilibrium is the midpoint of it. And what we want to see is it come down back into equilibrium and then reject higher. So moving away from equilibrium, right? So when we move away from equilibrium, that's when we can spot which side of the consolidation it might be starting to take out. So in this example, we took out the buy side or the consolidation high of the equilibrium. What we can expect it to do is come back down into it as a manipulation move. So when we come back down into it, we can be tapping into something for our manipulation move. Next, we have the expansion move. So expansion, also known in the power of three as the distribution phase, is when price moves quickly away from a level of equilibrium, and we will usually see this playing out in time after the Judas swing or manipulation phase has occurred. When we see price displacing over the consolidation high or low and leaving quickly away from equilibrium, this gives us an insight of the market maker's intended direction of where they are targeting to reprice the market. We can use things such as order blocks and breaker blocks to use to enter as a low risk entry to catch the expansion move. All right, so let's dissect this as well. All right, so once we break out of that consolidation, right, we displace lower, we displace higher, right, we're going to create our Judas swing, right? We're going to retrace back higher or we're going to retrace back lower into something, or we're going to retrace higher to take out liquidity or retrace lower to take out liquidity there. One of the two, we're going to take out liquidity or we're going to tap into some type of PDA for the Judas swing, okay? When we tap into that, primarily of the time, it's going to be one of three things. It's going to be either an order block, a breaker block, or it's going to be a fair value gap. But majority of the time, it's going to be either an order block or a breaker block, because that is where all of the smart money or market makers build up their orders inside of that one order block. And that order block is where all the market makers have their orders in, all right? But when we have this, okay, when we have that order block formed, what we want to do is we want to have our trade entry there, and then we're going to want to trade based off of that entry. So based off of this order block here, when the market expands lower, we're going to retrace back up into this order block, and we can enter for a quick short here to retrace or to expand lower, all right? So understanding when the expansion move happens, which is after the manipulation move, which is called the Judas swing, we can understand the expansion move will be occurring after that has happened or played out in time in the market. So retracement. Retracement is a phase that will usually occur after the expansion phase has happened, and it is when price moves back into the recently created price range. This will usually happen when price has not yet reached its intended target, so it pulls back into some type of area to collect more liquidity, or balance price to finally reach price's intended price. Alright? This is our indication that market makers will have a willingness to reprice towards levels that were not efficiently traded for, other known as fair value, or it's a sign for us to anticipate the market to reprice to areas that were not inside the area for an enough amount of time. In this phase, we can look for fair value gaps, premium and discount, optimal trade entry, and inefficiencies. Alright, so retracement is when you already have the expansion phase. Alright, so if we take a look at this, we have our Judas swing here, take out liquidity to the buy side, we expand lower, creating our high, creating our low. So we're having our trading range from our high to our low. This is our recently created trading range, or also known as our expansion leg. Alright? What price is going to want to do is one of two things. It's going to retrace back into optimal trade entry. It's going to retrace back up into premium. If we're trading lower, it's going to retrace into premium, equilibrium, OTE, so 0.71 0.618 range, right? Which would be probably right here. Or it's going to retrace back up into some type of inefficiency, so like a fair value gap. And we can use all of these, all right? We can use all of these for our retracement, but it's going to do one of these things, all right? Or it could do all of these things, all right? So understanding where the retracement could occur, which is after price has reached some type of target to then wanting to reach a lower target, it can retrace back up to gather more liquidity, or it can retrace back up to then reject even lower, or it can retrace back up to filling that gap of fair value. So remember, fair value is price hasn't been in that area for a long enough time to balance price. So for price to be balanced again, it needs to come back up into that gap of fair value to then retrace lower after it tapped into that P-area. So like an inefficiency, for example, a fair value gap. So in this example, price has came down, created our expansion leg. Price retraced back up into not only equilibrium, not only premium, but also retraced back up into this fair value gap. Okay, so retracing back up to this fair value gap has given us the opportunity to then reprice lower for a lower price target. All right. So understanding that this will occur, all right, in time, we can anticipate retracement happening like this after the expansion move, and we can anticipate that it's going to retrace into one of these things here listed below. And just like this model on the bottom here as well, we retrace back up into a fair value gap, which was right above 0.79, which is the max decimal point or value for optimal trade entry retracement. So finally, the last part of the IPDA will be the reversal phase. So reversal is a phase that will usually occur after the expansion move. This is when price moves in the opposite direction of when current market price is in. When price reverses direction, it indicates the market makers ran a level of stops, tapped into their intended reprice level, and or targeting a new level of price, to then intend that a new significant move should unfold in the new direction. We can look for liquidity pools above old price highs and below old price lows, and this includes sweeps, stop hunts, stop raids, turtle soups, false breaks, and retail sentiment. So false breaks are known as retail sentiment or people sentiment, what people perceive. So when people trade retail, they're going to see higher highs, higher lows, or they're going to see support and resistance. And when it breaks that support, they're going to consider that as a false break if they don't have a retest. And that's something that you guys can look up on Google right now. Go on Google, search up false breaks or retest support and resistance on Google, and that'll show you what retail traders trade, and that is not how we trade. Okay, so when we look at the reversal, this will usually be occurring after tapping a higher time frame PD rate, which is the market sentiment. Okay, markets target this, and algorithms target this, and market makers target this, because this is the price that they want to reprice to. Once they reach that price, they have another price that they want to target after that, and they're going to continue with that cycle of targeting prices, repricing, and after it hits a price, it's going to hit another price in the opposite direction. So understanding this, we can use this for our advantage for taking on more trades like this. Okay, so just like here, took out liquidity to the south side here, which would be our Judas swing here. We have our first expansion move here. Once we hit our taking out buy side liquidity, maybe even tapping into a higher time frame for value gap or order block here, what do? We reverse down lower now. And that's an example of reversal. Alright. And finally, this is everything that you need to know about time and price theory right here, right now. And this is the ANDX cycle, which is the complete algorithm. Complete time and price algorithm. This is everything combined that I have taught you guys about time and price all together. If you guys can understand this and grasp this, you can anticipate almost every market move. And I promise you, this is something you guys need to understand. Okay? So, AMDX, also known as accumulation, manipulation, distribution, into retracement or reversal. This is combining the power of 3, the interbank price delivery algorithm, and quarterly theory. And this is the complete market algorithm of time and price. So the focal points that you want to pay attention to is true opens. So true opens occur at the beginning of quarter 2 of every single cycle, which are aligned with the ICT kill zones. So the ICT kill zones will usually be between quarter 2 and quarter 3. That's where the ICT kill zones usually will occur. And every single cycle, going from the yearly cycle all the way down to the 90-minute cycles, quarter 2 and quarter 3 will usually be the kill zones. And quarter 2 will always and most definitely start those kill zones. So understanding that true opens, you can anticipate that in this model. In this model. When we reprice higher, quarter 2 starts. Tap into a higher time frame PDA. Most of the time, that'll be our Judas swing, sweeping buy side, tapping into a higher time frame PDA, which would be a turtle soup. Our Judas swing into a turtle soup. Quarter 3 occurs, we have our expansion move. We can either retrace back into true open, or once we hit true open, we will reverse. So tap into true open, we reverse, or we push past true open to then retrace back into true open to then reprice lower. The next focal point you want to focus on is session cycles. To get the session cycles, you begin that by starting each session time and then splitting each 4 quarters into 90-minute intervals. So you get your 90-minute intervals by having the 4 quarters per session. And you can go back into the previous mentorship videos to look at that, as I had showed you the pictures of that. We want to be finding our trade setups in quarter 2 all the way to quarter 3, which are the manipulation and distribution phases. Finding quarter 2 and quarter 3, which are the manipulation distribution phases, we can use this as an advantage to us or for an edge over the market, because we can anticipate when this manipulation phase will occur and when we can put on an entry for that distribution leg, and we can catch that distribution leg for a trade. So understanding the 4 cycles or the 4 quarters, and we can understand that with combining it with IPD and power of 3, we can use accumulation into, or consolidation into expansion, and we can use that into a reversal. So consolidation, expansion, reversal for IPDA. For power of 3, accumulation, manipulation, distribution. For quarterly theory, quarter 1 is accumulation, quarter 2 is manipulation, quarter 3 is expansion, or quarter 3 is distribution, and quarter 4 is retracement, retracing back into true open. So combining all of these, you see how all of them line up. Quarter 1, we have power of 3 happening right here. Accumulation, manipulation quarter 2, distribution quarter 3, and quarter 4. IPDA, consolidation quarter 1, expansion quarter 2, reversal quarter 3, retracement quarter 4. Consolidation quarter 1, expansion quarter 2, reversal quarter 3, expansion quarter 4. Finally, for quarterly theory, we have the AMDX cycle, which would be accumulation for quarter 1, manipulation quarter 2, distribution quarter 3, retracement to then for a continuation for quarter 4. And that is the AMDX cycle. So understanding the AMDX cycle, which is combining all 3, quarterly theory, power of 3, and interbank price delivery algorithm, this completes your idea of time and price. So if you do not understand time and price theory, you're not going to be able to conceive or have the perspective of what market makers see. So you guys need to take these notes, and you need to watch this video over and over again if you do not understand time and price theory. And if you think, oh, I know time and price theory, if I asked you, what is the purpose of accumulation? What's the purpose of distribution? Why does retracing happen? Why does a reversal happen? If you cannot answer any single one of those questions, you don't know time and price. If you can answer any of these topics, if someone asks you what's accumulation, what's the purpose of it? If someone asks you what's the purpose of reversal, if you can answer those questions, That's when you know what time and price theory is. So understand this, take these notes, and watch this video over and over again, because time and price is probably one of the most, if not the most important aspect or concept to learn with ICT concepts. So understanding this with smart money is very important, and it's very important for having an edge over the market. And finally, we have our cliff notes. Okay, so remember, understanding the complete idea of time and price theory is the basis of how the algorithm works and the whole perception of the closest we can get to how market makers trade. So we don't have indefinite facts or details of how market makers trade, but this is the closest we can get to it by understanding what the algorithm does, because market makers know that algorithm and they trade based off of that algorithm. So we can understand the algorithm, we can understand when the manipulation phase will occur and how it will happen. All right. Next, we need to know how time and price runs, because with one, the other doesn't exist. And without time and price, smart money could not have the ability to reprice to a certain value in a certain amount of time. Okay, so we need to understand, without time, price is irrelevant. Without price, time is irrelevant. So they go hand in hand. And without both of them, smart money does not have an advantage over retail traders in the market. So remember, smart money uses time and price for their advantage to put on that manipulation so they can take advantage of the liquidity inside of the market. So time and price should always be the foundation of what model, what bias, and what analysis you are trying to build, because without time and price, the analysis we develop would be irrelevant, and we would be gambling like the rest of the 90% of retail. So remember, without time and price theory and having it grasped and understood, we are basically gambling just like the rest of retail traders. Remember, 90% of retail traders and all retail, they fail. They do not make a career. They do not make money. They do not make a living out of this. So understanding time and price theory gives us that advantage over those retail traders to put us in that 10%, 5%, 1 percentile of traders that are successful with day trading and that make a career and make a living out of this. So understanding this is super important, and I really trust that you guys take notes on this, watch this video again, and also pay attention to what is in this video, and ask yourselves these questions. What does this mean? What does that mean? What does this mean? And also, every concept that I teach you guys inside these mentorships, I want you to go into the live markets and I want you to spot these concepts for yourself. When you're tape reading, your guys' homework is to tape read an hour a day. When you're tape reading, I want you guys to spot these concepts. And if you aren't spotting every single concept, pick a concept and try to spot it happening in real time. Or even go back in time, see one of these concepts occurring. You see that the market swept buy sell liquidity and then retraced lower. Boom, that's a Judas swing into distribution leg. You see price retraces higher back into a fair value gap and then reprices lower. Boom, that's a retracement phase. We have market building up liquidity, consolidating. Market trades up higher, taps into like a 4-hour fair value gap, and then retraces lower, passing that original consolidation phase. And then, that's AMDX right there. That's AMDX right there. Super simple. IPDA. Super simple. If you guys can spot these, you guys will get familiar with time and price theory. So understanding this in the live markets and applying what I'm teaching you, that gives you the whole picture. I can teach you guys as much as I can, but without you guys actually applying it and seeing it in the live markets, I can't make you guys put in the effort. Only you guys can. I'm giving you the sauce. It depends if you're going to cook with it or not. Alright? Finally, we need to be understanding this to develop our setups to be a higher probability, and so we can be aware and confident, supposed to say confident, in what price could possibly do. So we want to be confident in what price could possibly do. We want to be aware of what price could possibly do. And we want our setups to be higher probability, to be prepared for what price could possibly do. So understanding all of this will then give us our results of how we trade. Okay, so I hope you guys took notes. I hope you guys paid attention. I hope you guys paused the video so you could take those notes and grasp what I'm saying. Every time I say something that's confusing, I hope you could grasp it. And if you were confused, I hope you guys can watch this video back and watch it. And then once you guys go into the live charts to either tape read, backtest, or live trade, hope you guys can start to identify these concepts playing out in real time. Alright? Make sure you guys do your guys' tape reading. Make sure you guys backtest. Make sure you guys trade. Alright? Now, I'm giving you guys the information, giving you guys the education. You guys need to apply it, because if you don't apply it, this isn't going to work. I'm giving you 50%, you guys need to give yourselves the other 50%. I'm giving you guys the sauce, you guys need to cook with it. Alright? So without anything else to being said, I hope you guys found this very educating for you guys. I hope you guys took notes. Make sure the next time you guys start to tape read or look at those charts, take a look at these notes, look back at it, see if there's anything that you guys can spot. Until the next video, I'll see you guys later.